the Chief Investment Officer at Vanguard, managing around $8 trillion in assets. He joins me now. Sir, do you still subscribe to 60-40?
Absolutely. I mean, it plays a vital role in terms of the diversification benefits of having exposure to equities as well as bonds. Recognizing that the year of 2022, we saw a downturn in both the equity market and the bond market. But if you look over a longer period of time, on a risk-adjusted basis, a 60-40 portfolio for most investors who are saving for retirement or their kids' college education still makes a tremendous amount of sense.
You see, that's a huge difference, isn't it? You're talking sensible investment over the long term. Most people are looking for a quick buck or a quick speculative. I mean, the whole meme stock stuff. How do you get investors to turn away from that? I need to make 10, 15% and back to, as you're forecasting, 4 to 6%.
Well, the reality is, when you start talking about meme stocks, you're talking about speculation. Speculation is not investing. And so, unfortunately, people have to learn a very painful lesson that, we've seen this before when you think about the dot-com era of the early 2000s. And so, you see significant repricing. So people think they can make money relatively quickly by jumping on the bandwagon and being invested in momentum stocks. But that's not investing. Again, that's speculating, and that's not how you save for retirement or your kids' college education.
Your experts at Vanguard describe the latest prices in the market as frothy, the word that they use. Now, the thing about froth is it comes off the top and it can be wiped off the top. But you're still overall bullish on the question of equities.
Yeah, Richard, that's a great question. The reality is, again, when we're talking about folks who are investing for the long term, 10 plus years, 20 years, having exposure to equities, even in an environment where in the short run they do look expensive, it still makes sense when people are investing for a 20-year time horizon, because we know equities in the long run tend to outperform all other asset classes. So we still think it's a very vital asset allocation component for people's portfolios.
The bonds, I mean, classic bonds. All right, your principal is lower, even though you're now getting a relative higher interest rate because of rates. But where does fixed income fit into it?
Well, the great thing about fixed income today relative to where we have been for the last 10 years or so is that you're actually earning a reasonable level of income. You look at money markets today that are producing a yield of about 5.25%, which is way better than when they were flattened down to 0% because of Fed policy. So investors are being compensated for saving and investing in money markets. And the same thing is happening on the bond side as well, where you're actually earning a yield that's greater than the level of inflation, which is not something that we've seen over the last 10 years. So investors can start to feel much more comfortable having exposure to cash, having exposure to bond funds, because the yields are much greater than what we've seen. And our expectations for the next 10 years are that folks who are investing in highly diversified bond portfolios are going to produce returns in the 4 to 4.5% type range.
Cash, good old-fashioned cash. Got the piggy bank here to help it along. Cash is always king, they say. I don't know.
It's interesting. I mean, again, when you're looking at money markets at 5.25%, relative to investors who might be keeping deposits at a bank account where they're earning less than 0.5%. That's money that they're leaving on the table that could be more wisely invested in an asset that produces really good returns and ultimately is safe.
I've got to ask you, Greg, about this net zero business. Vanguard pulled out of this alliance, basically claiming a fiduciary relationship requires you to be more independent. But where do you balance the requirements? Where do you balance the requirements of ESG/climate change versus an investment? I mean, because you can obviously make more money if you just put it all into fossil fuel type of things, but that's not exactly the best way forward.
Well, we want to offer investment products for clients based upon what aligns to their values. So we have a variety of funds that are ESG oriented for those investors that want to have and invest with that style and that approach. But at the end of the day, when we think about our active management, so when we look at fixed income, our analysts are constantly looking at a variety of risk factors, credit risk, the environmental risk. And in an active fund, if it's not ESG aligned, the goal is to add value for our clients. And so if that risk is properly priced, and we feel like the market at the end of the day is not reflecting that risk appropriately, we'll position a portfolio accordingly. But again, we will invest in a variety of different sectors, different industries, different companies, but the goal here for our active funds are going to be to try to add value relative to their benchmarks. But those clients that want an ESG type product, we have funds that are aligned with their style of investing.
Lots of them. Thank you, sir. I'm very glad you came in. We need to check in again towards the end of the year, if we may, or at least and then the next year, just so we had an update on where we're standing. But thank you. It's good to see you. Kind of you to come.
Great seeing you as well. Thank you.
Now, we were talking there about